What's up, military millionaires? I want to talk to you about real estate investing in 2021 and what you need to know if you want to be successful. So we all know, and I'm going to grab my handy dandy bullet points that I wrote here, but 2020 was a year of fear and opportunity for real estate investors. And while that's gone and done with, and some people did very well and some people did not do so well and some people just panicked, I want to talk to you about 2021 and what we have going on. But first, you need to subscribe and smash that like button. All right, look, 2021 is actually looming with the exact same fears and uncertainties as what 2020 happened to have, and there's definitely the possibility of some things not working out so well. You never know. So just keep that in mind and know that, 2021 is scary, oh no. But look, check it out. I wanted to talk to you guys real briefly to ensure that you know where I stand on this, right? Like, I'm still investing, I'm still buying stuff, I'm still working in 2021. I'm not slowing down, I'm not stopping. And I think there's a lot of opportunity for you guys to take advantage of all this. So that's why I want to talk on this. I want to touch on this video so that this will give you some ideas for things that you can do in 2021 to help yourself out, create that buffer and take advantage of these opportunities as opposed to sitting on the sideline and waiting. The first thing that I'm doing in 2021 to capitalize on everything is I'm focusing on finding off-market deals. I'm not trying to buy into the seller hype where you're putting something on the MLS and it's going for $1 million. I am trying to find off-market deals that I can buy below market value. And then maybe I sell them, or maybe I hold them, or maybe I do whatever, but I'm focusing on that equity play where I have a buffer in case the market starts to go down. Secondly, I'm taking advantage of this low interest debt, right? So anything I can buy with leverage, I'm going to buy with leverage as opposed to cash, or as opposed to hard money, or opposed to whatever. If I can get bank debt that's at, if it's for my personal loan, for like a VA loan, it's gonna be like 2.5%, whatever, 2.25%, 2.75%, I don't care, 3, whatever. And I'm going to hold it because that's long-term, like 30-year amortization, long-term solid debt, and I'm really excited about that. But even my investment stuff, right? I was getting 5.25% interest like 2 years ago. Now I'm able to get 3.5%, 4.5%, and that's still the long-term debt. Over time, that absolutely pays off to have that lower interest rate, and you can lower your payments, increase your cash flow, or lower the term and increase your principal pay down. Lots of opportunities there, so I'm definitely focusing on taking on that low interest leverage debt. I already kind of touched on this, but I'm focusing on like 70% loan to value in the equity, right? Like, I want to be below 70% value of the property at my purchase price. I'm budgeting for higher vacancy and expenses, so that could be, the higher vacancy is just because there's a chance that there will be some evictions or some vacancy with everything going on. People aren't moving quite as much. But the expenses in general, some of that might be like repairs because the cost of materials has gone up. So your renovations and maintenance have gone up a little bit. Some of that's just budgeting in general for more expenses just because it's kind of uncertain what's coming. So the more conservative you are, the better off you'll be long term. And that's kind of where I'm thinking with all this. I'm also focused on building a decently high cash position. Now, I don't mean I want to have $500,000 in cash laying around liquid, because I actually kind of worry about inflation hitting potentially. And I also don't want to really miss out on that low interest debt, right? So what I'm talking about here is more specific to having like 50 to 100,000 in like operating capital that I can keep rolling through properties and building. And then what I'm going to do is, like, once I say I hit 100,000 and I can buy a property that nets me, I can flip it for 15 or wholesale it for 15 or whatever, then I'll take that and use that as a down payment on like a $100,000 long-term buy and hold with that low interest debt. And I'll take that same 100. So instead of using that 100 to buy all these smaller properties, I'm using that 100 to fund marketing and wholetailing to buy the next properties with the cash flow from that. And then I still have that cash in case something happens. Hope that kind of makes sense. Just having enough cash on hand, like operating capital, to really run my own business and have some legs once I'm out, because it's gonna be a little different once I'm out of the military. I'm actually focused on trying to target like retiring landlords. So I haven't had a ton of luck with the seller financing. My thought on this is that the seller financing, like those retiring landlords can be like, hey, here's some more cash flow and I'll take your property and we'll balloon it out at 10 years, which is awesome. But I mean, the debt terms right now are so great that it almost makes sense to just use the debt terms right now instead of the seller financing. But I'm targeting those retiring landlords because some of them have 2, 3, 4, 10, 15 properties, and they might be willing to sell all of them in a portfolio, or they sell you one and then maybe they sell you another one, whatever. So I'm looking for these opportunities to buy from landlords where I might be able to get a decent deal. Houses have been maintained, maybe there's already tenants in them, or maybe it's a landlord who just had a really rough experience, and all of a sudden I'm like, okay, well, I've got this crappy house, so I need to continue to have this crappy house, or I can flip it, right? And so that allows you to flip and have that buffer or whatever in there. So I like the landlord. I mean, I'm targeting everyone, but I like that retiring landlord niche. I'm going to continue to invest in my area, but I'm going to keep my thumb on the pulse of kind of some market indicators, right? So I'm going to be looking for things like inventory on homes, if it starts to climb back up, if builders stop pulling permits, if mortgage defaults climb, if foreclosures start to climb, forbearance numbers, and then interest rates, right? That kind of can drive how fast a market rises or falls. So I'm kind of trying to focus on all of those things, but I'm definitely still buying in my market. I would recommend that you keep a pulse on all that stuff so you can kind of tell if inventory starts to creep back up, like, okay, well, we might be getting towards the end of this kind of bull run. Refinances are already dying down, so you never really know. So just keep your thumb on the pulse in your area. I'm screening tenants better. Not to say that I wasn't screening tenants well before, but definitely looking for those more high class, the tenants with a really stable job, right? I'm concerned about where the income's coming from, making sure they have 3 times the monthly payment for their income and actually able to afford this property. The last thing you want to do is take on a tenant and then they can't pay you. Just not a good spot to be in. Oh, and that's even more so because if they can't pay you and then you can't evict them because of COVID, like if the reason they can't pay you. So make sure it's stable, do your due diligence screening, because you don't want to get stuck in that situation. And then the last thing is, and I'm doing, and I would recommend that you do, is refinancing properties that you have enough equity in to get that lower rate. If you plan on holding something for the long term, try to lock in a super low rate on it, and you should be all right as far as those terms for the long term, right? Like you have a lower payment, you're able to make more cash flow long term, or you can even shorten it from a 30-year to a 15-year or whatever to cut down, to increase the amount of principal you pay and cut down on interest overall. But those are both moves that I've got videos on refinancing, when to do it, when to not do it, what kind to do, and all that stuff. Just make sure that you're focusing with those videos on and whatever on your research on how long you're going to own the property. If you only plan on owning the property for 4 or 5 years, it's probably not worth your time to refinance. I mean, if you go from a 30-year to a 15-year, I think it's like 20 years is kind of the turnaround point for when you finally start to reap the benefits of the extra payments. So, take it for what it's worth and understand how long you plan to hold the property plays into whether these are worth it. But those are kind of my thoughts on 2021 and some strategies that I'm going to use and some things that you can do to hedge your losses and hedge your bets. Definitely do your research and make sure that you are fairly comfortable with everything going on, and just don't take risks that you can't afford. That's the key. Make sure you subscribe and smash that like button.